Discounted cash flow valuation. The traditional approach to the valuation of an income flow from a property has already been considered. Suppose the value of an income flow for the next 4 years payable in arrears from a freehold property, if the property is considered to be an 8% risk, can be calculated as follows. Example 1. Net income N10,000 equals per annum. YP 4 years at 8% 3.3121. Capital value N33,121. But years purchase is the addition of the PVS of N1 for each of the years under consideration, so an alternative method could be. Example 2. First year's income N10,000 x PV N1 in 1 year at 8%. N10,000 x 0.9259259 equals N9,259.259. Second year's income N10,000 x PV N1 in 2 YRS at 8%. N10,000 x 0.8573388 equals N8,573.388. Third year's income N10,000 x PV N1 in 3 YRS at 8%. N10,000 x 0.7938322 equals N7,938.322. Fourth year's income N10,000 x PV N1 in 4 YRS at 8%. N10,000 x 0.7350299 equals N7,350.299. N33,121.268. The addition of the present values, P.Vs, for each of the 4 years gives a figure of 3.3121, i.e. 0.9259259 plus 0.8573388 plus 0.7938322 plus 0.7350299, which is equal to PVN1 in 4 YRS at 8% used in example 1. From example 1, we can see that the traditional investment method of valuation is, in fact, a technique of DCF. The two methods are very much related to each other, but, in recent times, more complex discounted cash flow calculations have been done because of the need to build into a valuation more variables. Since more properties are now available for purchase and very large sums of money are required to purchase them. Besides, every conceivable variable which could affect the ultimate price must be examined, e.g. relating cost of borrowing with base lending rates of banks, accounting for changes in anticipated interest rates, tax commitments, and so on. However, there is no excuse for avoiding the use of DCF if there is need to reflect the effect of these complex variables in property valuations, and there is no point using them unless they provide better result than the simpler traditional approach would provide. When DCF techniques are used, it should be remembered that they are variations on the basic compound interest theme, which is the basis of all valuations. All future receipts and liabilities are discounted to a common date to enable an accurate appraisal to be made with other investments. The discounted cash flow, DCF, approach. The DCF approach, unlike the conventional method which uses an all-risk yield derived from analyses of comparable sales to determine the rate applicable to the class of property under consideration, accepts a rate which is competitive with what is offered by alternative but comparable investments for the investor's funds. This is known as the opportunity cost of investment funds. It is the basis of a risk-less rate of discount. Therefore, any investment with poorer liquidity factor, or higher risk to income or capital, will require a risk premium to be added to the risk-less rate. DCF rate % equals current rate on gilt-edged securities, opportunity cost rate, plus risk premium. Analysts generally accept the current rate on gilt-edged stock because they are fairly liquid investments, generally safe in money terms, even if gilt-edged stocks are sold at a loss or at a gain. It can be reasonably assumed that there would have a similar movement in the values of most other forms of investment. Properties which are considered less liquid or with higher risk to income or capital, are expected to achieve a risk premium of 1 to 2% above the going rate on gilt-edged stocks. DCF Capitalizations maintains that the appropriate rate should be one based on opportunity cost rate, i.e. the alternative rate the investor could obtain for his funds from other investments, particularly gilt-edged securities. In term and reversion valuations, while the conventional valuation would capitalize term at say, 5% to reflect the security of the term income over the reversionary income, the DCF would discount the term and deferment at the same opportunity cost rate, about 15% in Nigeria, 2007, plus risk premium of 1-2%, the reversion is then discounted at market rate. Example 3. Value by the conventional capitalization and DCF methods, a freehold property producing a net income of N5,000 equals PA for 5 years and N10,000 equals PA in perpetuity. The market capitalization rate is 6%. A. Conventional valuation. Net income N5,000 equals PA. YP5YRS at 5% 4.33. Value of term N12,600 equals. Reversion. Rental value N10,000 equals P.A. YP perp at 6% 16.67. PV N1 in 5 YRS at 6% 0.75. 12.50. Value of reversion N125,000 equals. Capital value N146,000 equals. B. DCF capitalization. Net income N5,000 equals P.A. YP5YRS at 17% 3.20. Value of term N16,000 equals. Reversion. Rental value N10,000 equals P.A. YP perp at 6% 16.67. PV N1 in 5 YS at 17% 0.46. X 7.67 equals. N76,000 equals. Capital value N92,000 equals. Notes. Market rate equals 6%. Opportunity cost rate equals 15%. Risk premium equals 2%. The capital value indicated by the DCF method is lower than that by the conventional approach. His is due to the higher discount rate employed in the DCF, which was derived from the gilt-edge, plus risk premium, totaling 17%. A lower rate was used in the conventional method. The DCF, unlike the conventional method, requires a more specific income flow and pattern. That is, periodic increases, income growth, must be accounted for, hence the valuer should forecast rents and discount at a rate sufficiently higher than the risk-free rate. The valuer's forecast will be based on the most probable rent due in n years' time, having considered past and present market conditions, rather than by extrapolation or other forecasting techniques. Assuming an increase of 25% in the income after 5 years is determined through market analysis, then in our example 3b, the estimated income at the end of the 5-year term will increase from N10,000 equals to N12,500 equals. Value of term as before. N16,000 equals. Reversion. Potential net income N12,500 equals. YP perp at 6% 16.67. PV5 YRS at 17% 0.46. 7.67 N95,875 equals. Value of interest N111,875. Example 4. The interest in a shop in a first-class position and one of the leading department shop groups is held on a 15-year Friday negotiated 8 years ago at a rent of N30,000 equals per annum. The tenant paid a premium of N91,552 equals on entry and covenanted to pay other premium of N92,625 equals and N149,120 equals respectively at the end of 5th and 10th years of the lease. Equivalent shop property in the neighborhood change hands at 8% freehold. Value the freehold interest by the DCF technique. Notes on the DCF valuation. I. Interest is freehold. 2. Term income is N30,000 equals PA net for 5 years. 3. The current gilt-edged securities yield of 15% is adjusted to 17% for property investment, i.e. 15% plus 2% risk premium. 4. Premium of N149,120 equals is receivable in 2 years' time. The other premiums, N91,552 and N92,625, are already paid. V. The rent fixed was in consideration of premiums paid, hence the rental value can be determined by adding to the rent received the annual equivalent of the premiums paid. Thus, 1 to 5 years 91,552 equals 91,552 equals N22,888 plus N30,000 equals N52,888. YP5 YRS at 8% 4. 6 to 10 years 92,625 equals 92,625 equals N13,804 plus N52,888 equals N66,692. YP10 YRS at 8% 6.71. 11 to 15 years 92,625 equals 149,120 equals N17,421 plus N66,692 equals N84,123. YP10 YRS at 8% 8.50. On close examination, there is a constant increase of about 26.12% every 5 years on the rental value. Hence, the rent for the 16th to 20th years at the same growth rate of 26.12% will be N84,113 x 1.2612, which is say, N106,000 equals. This growth rate should be confirmed by other market studies of the area, and therefore applied in the determination of the rental value after the term. Table 1. YRS from date of grant existing rent forecast. 1 to 6 N30,000. 7 to 10 N106,000. 11 to 15 N106,000 x 1.2612 N133,687. 16 to 20 N133,687 x 1.2612 N168,606. 21 to 25 N168,600 x 1.2612 N212,646. 26 to 30 N212,646 x 1.2612 N268,189. 31 to 35 N268,189 x 1.2612 N338,241. 36 to 40 N338,241 x 1.2612 N426,589. 41 to 45 N426,589 x 1.2612 N538,014. 46 to 50 N538,014 x 1.2612 N678,543. 51 perpetuity N678,543 x 1.2612 N855,778. DCF valuation. Year 1 to 6, unexpired. Net income N30,000 equals P.A. YP6 YRS at 17% 3.5892. N107,676 equals. Add premium due N149,120 equals. PV N1 in 2 YRS at 17% 0.7305. N108,932 equals. Value of term N2 16,608 equals. Reversion. Year 7 to 10. Rental value N106,000 equals P.A. YP4 YRS at 17% 2.7432. PV N1 in 6 YRS at 17% 0.3898. 1.0693. N113,345 equals. Year 11 to 15. Rental income N133,687 equals P.A. YP5 YRS at 17% 3.1993. PV N1 in 10 YRS at 17% 0.2080. 0.6655. N88,968 equals. Year 16 to 20. Rental income N168,606 equals P.A. YP5 YRS at 17% 3.1993. PV N1 in 15 YRS at 17% 0.0949. 0.3036. N51,188 equals. Year 21 to 25. Rental income N212,646 equals P.A. YP5YRS at 17% 3.1993. PVN1 in 20 YRS at 17% 0.0433. 0.1385. And 29,451 equals. Year 26 to 30. Rental income and 268,189 equals P.A. YP5YRS at 17% 3.1993. PVN1 in 25 YRS at 17% 0.0197. 0.0630. And 16,895 equals. Year 31 to 35. Rental income and 338,241 equals P.A. YP5YRS at 17% 3.1993. PVN1 in 30 YRS at 17% 0.0090. 0.0288. And 9,741 equals. Year 36 to 40. Rental income and 426,589 equals P.A. YP5YRS at 17% 3.1993. PVN1 in 35 YRS at 17% 0.0041. 0.0131. And 5,588 equals. Year 41 to 45. Rental income and 538,014 equals P.A. YP5YRS at 17% 3.1993. PVN1 in 40 YRS at 17% 0.0019. 0.0061. And 3,281 equals. Year 46 to 50. Rental income and 678,543 equals P.A. YP4YRS at 17% 3.1993. PVN1 in 45 YRS at 17% 0.009. 0.0029 and 1,968 equals. 51 Perpetuity. Rental income and 855,788 equals P.A. YP perp at 17% 5.8824. PVN1 in 50 YRS at 17% 0.004. 0.0024. And 2,054 equals. Capital value of property and 539,092 equals. The valuation could be done or set out alternatively as in Table 2 below. Table 2. Year's net income and potential capital receipts PVN1 PA, YP, at 17% PVN1 in N years at 17% PV factor PV sum. 0 to 6 and 30 0 0 0 3.5892, 3.5892 and 107,676. Year 2 and 149,000, 0.7305, 0.7305 and 108,932. 7 to 10 and 106,000, 2.7432, 0.3898, 1.0693 and 113,345. 11 to 15 and 133,687, 3.1993, 0.2080, 0.6655 and 88,968. 16 to 20 and 168,606.19930.09490.3036 and 51,188. 21 to 25 and 212,646 3.1930.04330.1385 and 29,451. 26 to 30 and 268,189 3.1930.01970.0630 and 16,895. 31 to 35 and 338,241 3.1930.09000.0288 and 9,741. 36 to 40 and 426,589 3.1930.00410.031 and 5,588. 41 to 45 and 538,014 3.1930.00190.0061 and 3,281. 46 to 50 and 678,543 3.1930.00900.0029 and 1,968. 51 perp and 855,788 5.882400.0040.0024 and 2,054. Capital value of property N539,092. Adapted from IFDIRA, 1993:477. The conventional valuation will produce the following. Term. Net income N30000 equals P.A. YP6YRS at 7% 4.78. And 143,400 equals. Add premium 149,120 equals. PV N1 in 2 YRS at 8% 0.86. And 128,243 equals. Value of term N2 71,643 equals. Reversion. Rental value N106,000 equals. YP perp at 8% 12.50. PV N1 in 6 YRS at 8% 0.63. 7.88. N835,280 equals. Capital value N1,106,923 equals. The value indicated by the conventional method is higher than that of the DCF method. This does not imply an error in either method. The implication is that an investor is not likely to purchase a property for N1,106,923 equals at 8% return when there is an alternative investment to be purchased at N562,606 which would produce a return of 17%. DCF method can also be used to value leasehold properties. Example 5. A residential property is held on a building lease now having 27 years unexpired, at a ground rent of N500 equals per annum. The house is let on an occupation lease having 3 years to run at a rent of N6,000 equals per annum. The current rental value of the property is N12,000 equals per annum. The freehold interest on similar property attracts 6% return. Value the leasehold interest by the conventional and DCF methods. Valuation. Notes. I. 3 yearly rental value appreciation of say, 10.8%. 2. 15% yield from gilt-edged security. 3. 3% risk premium appropriate to the class of property. A. Conventional valuation. Rent received N6,000 equals P.A. Less ground rent 500. Profit rent N5,500 equals YP3YRS at 6%/3%. Tax at 40% 1.6688. Value of term N9,178 equals. Reversion. Rental value N12,000 equals P.A. Less ground rent 500. Profit rental N11,500 equals YP24YRS at 7%/3%. Tax at 40% 8.4451. PVN1 in 3 YRS at 7% 0.8163. 6.8934. And 79,274 equals. And 88,452 equals. B. DCF valuation. Rental income analyses. The rent for the first 3 years, N6,000 equals P.A, is fixed by contract. Potential rental income after the first 3 yearly term at 10.8% may be taken to reflect current real market rental. Current rental value is N12,000 equals. Table 34.3. Years rental value ground rent net income or rental income less ground rent. 1 to 3 N6,000 equals less N500 equals N5,500 equals. 4 to 6 N12,000 equals X1.108 equals N13,500 equals less N500 equals N13,000 equals. 7 to 9 N13,500 equals X1.108 equals N15,000 equals less N500 equals N14,500 equals. 10 to 12 N15,000 equals X1.108 equals N16,500 equals less N500 equals N16,000 equals. 13 to 15 N16,500 equals X1.108 equals N18,500 equals less N500 equals N18,000 equals. 16 to 18 N18,500 equals X1.108 equals N20,000 equals less N500 equals N19,500 equals. 19 to 21 N20,000 equals X1.108 equals N22,500 equals less N500 equals N22,000 equals. 22 to 24 N22,500 equals X1.108 equals N25,000 equals less N500 equals N24,500 equals. 25 to 27 N25,000 equals X1.108 equals N27,500 equals less N500 equals N27,000 equals. The table of DCF valuation of leasehold interest is shown as Table 34.4. Table 34.4 DCF valuation of leasehold interest. Years net income and potential capital receipts PVN1 PA, YP, at 17% PVN1 in N years at 17% PV factor PV sum. 1 to 3 and 5, 500 equals 1.3904, 1.3904 and 7, 647.20. 4 to 6 and 13, 000 equals 1.3904, 0.6086, 0.8462 and 11, 000, 0.60. 7 to 9 and 14, 500 equals 1.3904, 0.3704, 0.5150 and 7, 467.50. 10 to 12 and 16, 000 equals